Okay, right, let's show volume up. Okay, so can you guys hear all right, or is it a bit very quiet? Sounds very quiet. How's that? Is that better? Is that better? Not doing very good. Okay, how's that? Is that better? Barely. Okay. All right. How's that? Is that better? That's okay. Okay. What are you guys? You guys okay for sound up there? Good nod. Yep. Yep. How are you guys up there for sound? How's that? Is that okay? And you guys okay for sound? Good. Right. Okay, if you quiet down, we'll make a start. First thing, I've been asked to advertise this research project. I don't know what they're researching, but if you have searched for information on the All Blacks on the internet, then you can participate in this research project. And so this is the email here, Anusha Anithran at canterbury.ac.nz. If you want to participate, contact her, and you get a Pack and Save voucher for your efforts, I gather. Right. Okay, so that's the ad. Now back to the serious business. Again, I'm going to skip trying to recap, seeing how there's still quite a bit to do in this section. It's always a bit hard to squeeze stock markets into 3 lectures. So we're going to talk about stock market and risk, because this is the one place where we try to actually get a risk measure and then turn that risk measure into a discount rate that we're going to use to value our securities. So first thing is to try to figure out the difference between what we call systematic and unsystematic risk. Anyone met either of those? Have you met it already in 201, or is that still to come? 102 you met it. Do you remember what it was? No, it's the other one. You get rid of the unsystematic risk. Yeah. Okay, so when you look at any individual stock, there's actually like 2 types of risk built into it, one of which we call the systematic risk and the other the unsystematic risk. And in one sense, the unsystematic risk is the type of risk that you can get rid of if you diversify properly. So if you think about how on earth we're going to measure risk in the first place, Topman says there that we measure the risk by the standard deviation return. So if we simply draw a graph of what that means, let's take these on a daily basis. So this axis here is the daily returns on some stock, and then that's the probability of getting those returns. Most stocks have a small positive returns, and you get some distribution around the mean. And in there's some spread. That's your standard deviation, roughly. And that's the thing that we use to measure the risk. Now, the problem, in a sense, there is a problem with this one, is that when you actually go and measure that for any individual stock, that standard deviation actually includes both types of risks, both the systematic risk and the unsystematic risk. And so what we're going to do is going to try to separate these 2 risks and try to figure out how much of this total risk is systematic risk and how much of this total risk is unsystematic risk. Because as we progress, what we'll do, we'll make a conjecture that in terms of the reward that you get, you are only rewarded for holding the systematic risk. Because, at least in theory, you can get rid of all the unsystematic risk with proper diversification. So if you can get rid of that risk simply by diversifying, then you don't get rewarded for it. So what we want to do is sort of think about how on earth we're going to pick these two things apart. So let's draw another diagram here. So in this time, we'll have the return on the market. And we'll make these daily ones. And this is, up here, return on stock X, whatever stock X might be. So we go out and collect a bunch of daily data. So every day, for every day, maybe say, past 5 years or something, we have a daily return on the market, whatever that was, and we also have a daily return for our individual stock. And we're going to this is made-up data, we're going to plot them on our graph. So we get a bunch of daily points. So each one of these points here is, a daily observation. So make these things stretch up here. These should be spots rather than nice lines, but anyway. That's probably enough daily data for it. So when we're thinking about what this is, up in this quadrant over here, the market was up and the stock was up on those days. So each of these days here represent a time, a particular day when the stock market went up, but also our individual stock that we're looking at also went up at the same time. Down here in this quadrant, the market went up, but the stock itself went down. So we have a positive return on the market in this part of the world, but we have a negative return on our stock. Over here, these days, the market was down, and our stock was down as well. And the final one, up in here, is when the market was down, but the stock was up. So the way we've drawn it, what we can see there is a tendency for the stock to do what the broad market does. I mean, it's part of the market, so that's not unexpected. But there's also some scatter around that. And so when we're thinking about trying to split these risk into two pieces, the tendency of the stock to do what the market does is what we're going to term our systematic risk. And so the way we do that is we simply shove a line through here. And if you were actually doing this in real life, you simply shove this into a linear regression in your software package, and it would get you a nice line. So we'll shove that line through there. And that line, although it's nice and straight, that is what we call the systematic risk of the stock. It is the tendency of that stock to do what the market does. And so this one here, this line here, this is our measure of the systematic risk. And this is the thing that we call the beta, or the betas. That's the Greek letter beta. So the slope of this line, the slope of that line is equal to the beta. Now, of course, there's more risk there than can be explained by this line, because you've got this scatter in terms of your data points around that line. So if we just pick a point, let's say we pick the point here, this particular point here, this return on the market, then you would expect that the stock would go up about there, but in actual fact you get a scatter around this line, this black line here. So if we draw a nice line through there, and I tip it on the side so I can draw this thing, you get some distribution around that mean point. Tip it back the other way. So it's this scatter around that point, scatter around that line, which we speak of as being the unsystematic risk. And so the scatter, approximately the unsystematic risk. Okay, any questions to this point? So everybody's happy? Okay. So the beta estimates, the beta estimates, the systematic risk. That's what we're going to use. And that's simply that slope. And it estimates the systematic risk of, in this case, our stock X. So that one there just chugs along like this. So we'll say that slope of that line was a 1. If the beta equals 1, then the risk of the stock is equal to the risk of the market. If it's flatter, say we have a line that goes through like this, say the stock was this one, and we ended up with a beta less than 1. So for beta less than 1, the risk of the stock is less than the risk of the market. And similarly, if it was steeper, say it went up here, beta greater than 1, beta greater than 1, the risk of the stock is greater than the risk of the market. Okay. Any questions on this so far? It's all clear to you? Okay, so we now have, at least conceptually, an idea of how we're going to take the total risk and split it into 2 pieces, and we have some idea that the one that really matters is the systematic risk, because if we can get rid of any risk, then through diversification, then there's no real reason for us to be compensated for that risk. If you think about, our basic principle, if we take a risk, we should be compensated for that risk. If you can simply get rid of that risk for free, which simply comes by diversification, then you should not be compensated for holding that type of risk. Now, with the beta risk, the tendency of that stock to do what the market does, there's no way to get rid of that in a long-only portfolio. So when we look at this diagram here, and if you ever actually try this with real stocks, it's quite surprising that the actual real graph comes out very much like that. I had an honor student do a project, probably 5 or 6 years ago now, and when she did this, and she was really startled that it actually came out, when she actually did this for real with real data, it came out looking exactly like this. So this one up here, this is the, if you have, this is one stock here on there, and of course one stock has lots of risk in it, of which some of it is this systematic risk, and this is the bit that we've been talking about for the beta down here, beta sort of type risk. And then there's all this stuff here, at least when you buy your first stock, that's all this additional risk that you're holding because you only hold one stock, for which, theoretically, you'll get no compensation for holding this. So as you add more securities to your portfolio, and this is one of the benefits of diversification, the amount of unsystematic risk you hold goes down. And it reaches a point where essentially you can, out here, and typically this is somewhere around 15 to 20 stocks, you cannot reduce your non-systematic risk anymore, and you're left with a portfolio which has basically systematic risk and nothing else, for which you should be, then earn some extra return. Now, this only applies to a long-only portfolio. Remember we talked, I think it was Tuesday, about shorting? You can get rid of your systematic risk by shorting. Okay, so we're talking about if you're a normal investor, you buy stocks and you hold stocks. You don't try to short stocks. If you only buy and hold, then you can get rid of all the unsystematic risk, but you'll be left with the systematic risk, and you can't get rid of that. And that at least in the theory of what you should be compensated for, that's the risk that you're going to be rewarded for holding. Okay, any questions? Any questions? Anybody? Okay, since you have it. Okay, so this is the assumption here. They're assumed to hold securities in a diversified portfolio. Okay, that's the assumption we make. Of course, many people are under-diversified in real life, but that's their stiff biscuits. So when you think about that thing there, and you ask, well, which risk should you be compensated for? If you can get rid of this stuff here, simply by get rid of that, simply by holding enough stocks, then there's no reason for you to have compensation for that type of risk. But you can't get rid of that one, the systematic risk, in a long-only portfolio, so that's the one that you'll get some compensation for. So there's the basic point. The systematic risk of the portfolio cannot be eliminated by adding more securities. So if you buy an index fund which holds every last stock in the entire market, then you've eliminated as much non-systematic risk as you can and left with the systematic risk. Now, probably one thing we should ask about, what would be an example of a stock having a non-systematic risk? We said it in general, it's this tendency to do its own thing. Yeah, go ahead. Yeah, something that's specific to the industry. And so, like, for example, if you held, say, Toyota, and suddenly they had to recall a faulty model of car, and something was a problem, they'd probably take a hit in their stock price. It wouldn't affect the general market, except the fact that Toyota is part of that market. Maybe some of their suppliers would be affected, but that is confined to a very limited number of stocks. And that's the type of thing that we're talking about when we talk about non-systematic risk, something that's confined either to an individual stock or maybe some sector like an industry sector of the market. And those things, hopefully, if you have a diversified portfolio, if your car stocks take a hit, some other stocks will have some good news and they will compensate for the loss that you have. Okay. Now, when we're thinking about that beta, and I drew this thing over here, and I quite specifically tried to make it a nice slope of 1. We simply do that by definition. We say that if you take the entire market, then the entire market has a beta of 1. And so when we put this bit here, beta equals 1 for your stock. The risk of the stock, in terms of systematic risk, is equal to the risk of the market. And so when we define this risk, we simply define the risk of the market to be 1 in terms of beta. It's not something you measure, it's something you define. So these ones up here, these are more risky. Those ones there are less risky. Now, if you're actually going to use this thing, because pretty soon we're going to try to figure out how to turn this risk measure into an actual discount rate, you should actually forecast it, what the beta is. Because even though you can actually estimate beta off historical data, it simply takes a bit of linear regression software to do it. The historical betas, they're very poor about forecasting the future betas. So here's some betas from certain groups. So if you take them as industry, banking industry, a 1.09, slightly more risky than the market as a whole. Biotechnology, you tend to think of that as a risky industry, and it does have a beta of 1.43. So significantly more risky than the market. Go down to retailing, down here, 0.42, significantly less risky than the market as a whole, as that group. And the real estate there, 0.8, so a bit less risky than the market. So those are historical ones. And they sort of match up with what we would expect. Biotechnology seems pretty risky, and of course it has a high beta. Now the question is, how on earth are we going to turn this thing into an actual discount rate? So the key assumption, and this is an assumption, is that the required rate of return depends linearly on the stock market systematic risk. So that means if we draw, this is our graph here. So here's our risk along this way, and this is our beta, and this is our return up here. If the relationship between risk and return is linear, all we need on that graph there is 2 points, and then we can just draw a nice straight line through it. The question is, can we get 2 points? Where can we get 2? Let's start off with one point. Can anybody think of where you might get 1 point on there? Just 1 point to stick on there. The origin, and what would that represent in terms of an investment, the origin? No risk, no return. Nope. Oh, well, okay, if there's no risk, we usually get a risk-free rate, don't we? Okay? So you can start off with 0 risk, but you still have a positive return because of that risk-free rate. So that is 1 point that we can stick on there. Okay, so we'll stick it up here, and the beta at that point is 0, and there is some risk-free rate. So we got 1 point. All we need is one more, and we can develop this model because it's nice and linear. Anyone else have any idea where we might get a second point on that graph? No, we need one more. Yeah, go ahead. Okay, so when we draw the thing, it's going to look like that. Yeah, it will. But we need a nice point to anchor it down where it is. Because at the moment we got 1 point, and we can put anything through there. We need a second point to anchor the line. The market, and it has beta 1. And what's its return? That's a trick question. I'm sorry. It's whatever the market return is, okay? Yeah. So, okay, so there's your market beta, and there is, and again, just because you're forecasting, okay, you have to forecast this, it's the expected return on the market. So up here, we have expected return on the market, and there you go. There they cross. So beta equals 1, expected return on the market, and there's our line. And that's the line that we're going to use to turn a risk measure, in this case the risk measure is beta, into a required rate of return or a discount rate. So if you're thinking about, the equation of a line, in general ones, is y equals a plus b times x. The a is the intercept, so this thing here, this line is going to give us, the expected return on pretty much anything, as long as we can get a beta. So in terms of that, expected return, let's just say it's stock, any stock, it's going to be the intercept. So this is the intercept here, the risk-free rate. Okay, that's the intercept. Now, what's the slope of this line? Because in a little linear equation like that, y equals a plus b times x, b is your slope. What's the slope of that line? Oh, sorry, I didn't see your hand. Yes, go ahead. Yeah, bang on. Good. So basic math, rise over run. In this case, the run is 1, so it makes it very easy when you divide. And so, this slope here, the slope of the line, is simply the expected return on the market minus the risk-free rate. So our conjecture is that this thing here is the beta is the x. Then we have beta times expected return on the market minus the risk-free rate. And another way to look at that, if we draw a line through here, change colors. This thing here is your risk premium. And that is this bit here. So what we can do now, it's a very simple model. Conjecture is that there's a linear relationship between systematic risk and your return. Is that for any given systematic risk, if you can estimate beta for your stock somehow or forecast that, you can work out what your expected return is, and then like if you're going to do those calculations of a dividend discount model and think, what number do I stick in there as my return? This is how you find that number. So if you're going to say value a stock by a dividend discount method, you think, I need that discount rate, and up until now we've just been plucking them out of the air. Here, where I can actually calculate what that discount rate should be. And by estimating the beta of the stock and the return on the market, and then plug it in, crank the handle, and out comes a required rate of return. So this particular model, this one here, just slide this up a bit. This is known as the capital asset pricing model. Often abbreviated CAPM. So that's probably the simplest model there is for getting a required rate of return for an individual stock. Okay, any question on this so far? Yeah, go ahead.
Systematic risk can be explained to the loanable fund theory? This isn't related to the loanable funds theory at all. It's just it's simply an observation that when people were developing this model back in the 1960s, this was simply an observation that had been made over many, many, many years, is that when the market goes up, most stocks go up. When the market goes down, most stocks go down. And it was based on work done in the 1950s about how much of the risk that was there, and the total risk of the stock could be eliminated through diversification. And that's where it came from. It didn't come out of anything about loanable funds. It was trying to analyze risk on the market, and then this coupled with this observation that most stocks do what the market does. It was those two things that led to the development of this model. So it wasn't around loaning money. Yep. Yeah. Yeah. It's just like, is it just kind of like default risk? Can it be that way to think that, the government won't have any default risk because they definitely pay money back?
Yeah, because if you think about where on earth do we get these things? Okay, let's ask the question: where on earth do we get these numbers? Because what we need here, we actually need three real things. We need a risk-free rate, we need a beta, and we need a return on the market. Because risk-free rate's actually in there twice. So that one you can actually simply go out and look up. You look up a T-bill of some sort. The beta, where are you going to get that? Okay, so you can get it from historical. If you're going to do it properly, you should forecast this. Okay, most people, they do historical data because forecasting is kind of hard. Where are you going to get the return on the market? You expect a return on the market. Okay, from past data.
Okay, so that's one way of doing it. Again, to do this properly, because this is an estimation, you should forecast it. Okay, I mean most people don't. Most people do not forecast the beta. They do not forecast the return on the market. But if you're doing it for investment, you really should. Most people simply use the start of the beta. So this one you can look up. Both of these, if you're using past data, you can estimate. If you're using forecast, then there's a lot of uncertainty around these because you're having to forecast them into the future. Okay, so there's the line in a bit nicer than what I drew, but the basic idea is still there. So let's do an example. So we're actually doing a numerical one here. Okay, so here's the example. Suppose the risk-free rate's 2%, expected market return is 10%, and the stock J has a beta 1.5. Assuming the past is a reliable guide to the future, what's the expected rate of return on stock J? So how are we going to calculate that? Risk premium first. So if you think in terms of expected return on J, risk-free rate plus beta times expected return on the market minus risk-free rate there. And so this thing here, that's your risk premium, and you want to work that out first. Good thing to do. So what's the expected return on the market? 10%. Okay. And risk-free rate? 2%. So that thing there, that's 8% in there. So the only thing we need left is the beta. Beta is given to us at 1.5. So the expected return on this particular stock is going to be 2%. That's your risk-free rate. Plus 1.5 times the 8% there, the risk premium. And that comes out at 14%. So once you have the 14%, if you then wanted to value your stock, whether it's a free cash flow method or dividend discount model or whatever, the 14% is the required return that you plug into those formulas to calculate the present value. So this is what it's doing. It's taking the estimate, this thing here, the beta, I put that in, beta is 1.5. That's our estimate of the risk there. We're turning that risk there and this risk premium into the risk premium for this particular stock. So you end up that your required rate of return on the stock of this riskiness is 14%, and that's the one that you plug into your formula when you do your valuation. Okay, any questions on that? Okay, we actually derived the CAPM in 205 as well using a bit of calculus. So there's another way of looking at it. Okay, so moving on. We're going to now just sort of wrap up this area here. Stock market indices. What's the purpose of a stock market indices or an index? Why do we have stock market indexes? There's lots of them. Very quiet. Okay, so the basic idea of having a stock market index is something to give us a comparison. And there's actually a wide range of indexes, but usually when you're dealing with an index, you usually take one that's a broad index of the whole market, and then you can either compare your performance, as your own portfolio against that index, or if you're dealing with a fund manager, you actually measure the performance of the fund manager against the relevant index. So when you actually make one, there's these two types, there's the price-weighted and the market-weighted. Anyone met how price-weighted? One knows how a price-weighted index index works. Oh, very quiet again. So essentially you take the price, the actual prices of the stocks in your index, and you add them all up and you divide them by some number. Now that number, of course, changes over time because of the weighting. Every time you change the stocks in your index, you change the number that you divide by. Basically, it's a simple average. You add up the prices and you divide by some number on the bottom. Now, probably the best known price index in the world is the Dow Jones. And when the Dow Jones got started, it had an integer on the bottom to divide by. But because they've changed the stocks in the index, every time they change it, they've got to change that divisor. And the divisor is now reported to 14 decimal places. But it's basic idea. Just add them all up, all the prices up, divide them, and this gives you your index. So what about the other one? Market value weighted index. You need a what? No, this is using actual market data. So let's see where's English. So the value weighted index, like Standard & Poor's 500. Now, New Zealand ones are actually a little bit different, but they're basically market value weighted. Is you simply multiply the number of stocks outstanding by the price for every stock and add that up. And then you have some initial point in time where you define what the index started at. And let's see. Where's that Standard & Poor's one? Oh, I lost my Standard & Poor's one. Anyway, so you start off, well, actually NASDAQ will do. NASDAQ does this. So they have a base year. They have a base year of 1970 when the start of the index, and they defined the index, I think at that point, to be something like 100. And then as the stock's value changes, because if you think of what's happening to the stocks, if they have stock splits, stock dividends, they buy stock back, it's going to change the number outstanding, the price changes, and so on. They simply add up the value of those stocks and then compare it to the previous day and adjust the index. And so it's simply, in one sense, a price index like the Dow Jones is a little bit less accurate than a market-weighted index like the Standard & Poor's 500 or our New Zealand indexes. Now, our ones are a little bit different. But in actual fact, if you look at the correlation between the Dow Jones and the Standard & Poor's 500, the correlation is around 0.96. So even though they're, Standard & Poor's 500 is probably more accurate, the other one is tracks along very closely with it. So there's lots of them around. Like, for example, you often get things like this capitalization. Once you have small cap, mid cap, large cap indices, you get industry sector indices, and they're all relevant to particular sectors of the financial industry. So Dow Jones is one of the older ones. This one here, the FTSE 100, is the most common one quoted over there. But you think in Australia, there's your main one. That's the one you normally hear quoted in the stock market report, the ASX 200. But if you go to their website, there's 31 indices in total that are there, covering all sorts of sectors of the market. So, like, for example, if you are a fund manager and you are managing a small cap fund, then your bosses want to know how you perform relative to the small cap index. And so they wouldn't use the main index because you're not investing in that part of it. You're investing in small caps, so they'll go and look up another index, and they'll measure your performance against that small index. Japan, the main one's that Nikkei 220. Hang Seng in Hong Kong, the main one there. In New Zealand, we've got a range of them. Last time I looked, there was about 9 of them. The thing that makes our one a little bit different is that instead of being a pure capitalization weighted index, they're what's called a free float index. And the difference between a pure capitalization index and a free float index is that the pure capitalization takes all stocks on issue. So let's say a company has issued 100 million shares, then in a pure capitalization index, they take all 100 million shares into account. In a free float, sometimes there is big chunks of shares which they know will not be traded. And so they simply take those out. And an example of where that's the case is if you buy shares in our winemaker delegates, 62% is held, I think last time I looked, 62% I think is held by the delegate's family. That is considered to be not available for trading. And when they use a free float index, they exclude all the shares held by the delegate family and only those that are available for public trading. So our indices, although they're broadly market capitalization indexes, because they're free float indices, they're not pure ones because there are some big holdings which are not available for trading. So you need to watch, what type of index you're looking at. The other interesting one we have is this one here, is the portfolio index. Some of our because our market is small, some companies are very large. They actually make up more than 5% of the total index. And what this tries to do is limit the effect of the largest capitalization stocks, because they say, well, although went back when they actually started doing this, Telecom, which now changed its name, it was about 25% of the total market. And they said, no one would hold 25% of portfolio in Telecom. And so they brought out this portfolio index, limited the rate to a maximum of 5% for any one stock to try to better reflect what investors were likely to do. Now, if you're an index fund manager, an index fund manager simply tries to track a particular index. And one of the good things about this for New Zealanders, if you invest in an actively managed fund, the capital gains is paid by the fund manager, okay, because they're defined to be traders. If you invest in an index fund in New Zealand, they can apply to the IRD for an exemption from that capital gains tax because they're not considered to be traders, they're passive investors, and that's one of the good reasons for investing in index funds in New Zealand is that you don't incur capital gains tax, which you do with an active investor. But the thing about them is that the index themselves are updated on a regular basis. There's usually a very well-defined way of doing this. And so what they tend to do, if you're thinking about what they're doing in terms of, say, the big index, is they're throwing out the losers and shoving in the winners. And that tends to overstate the overall performance of the market. So it's another thing to bear in mind as an investor, or if you end up as a fund manager, or somebody who said you want to be when you grow up to graduate. That the index itself probably overstates the performance of the market a little bit because of this. Keep throwing out the losers, keep shoving in the winners, tends to inflate the performance over time. Stock market isn't a forecaster, so I think this is the last bit. What do we expect the stock market actually to be able to forecast future economic conditions? What do we expect them to be able to do that, given what we understand about what a stock market is? Yeah, go ahead. Okay, so, you're looking forward, you see bad times, and you think dividend payment goes down, then you would reduce the valuation of that stock. Very simple reason to expect that the stock market might be able to forecast the future conditions. Because if you think, how we had, our simple models of dividend discount models, if we think either risk is going to go up or alternative, cash flow is going to go down, that affects the valuation. So there's good reason to think it might be able to do this. How well does it actually do? Anyone know how well it does in real life? No, I see some shaking of heads. In actual fact, depends on how you define well. It actually does actually do pretty well, considering that you're looking at the future. Now, the standard explanation is that it's not very good. Like you sort of get this thing here, this sort of number here. But when you actually look at it, if you just take straight, market decline, did that predict a recession? Typically, they're about 55% at that point, 55% right. But you think of the fact that the economy is actually only in recession typically around 20% of the time. That's actually quite good. But if you actually try to be a little bit more smart about your analysis, you can actually do a lot better. And this is data I picked up this morning. So these are bear markets. That's when the stock market goes down. And the white ones here, the little white bear pools from these bear markets, is when the recessions did not occur. And the red one is where a recession followed, a bear market goes down, you get a recession. These are the red ones. So, and you think, oh, that's kind of random. But when you look at it, it's hard to pick it apart. The average bear market length is 362 days, but the short bear markets do not lead to a recession. So the average one, the bear market that did not lead to a recession, was only 192 days long, but the ones that did lead to a recession were longer. 508 days on average were the ones that led to a recession. So the share market, the stock market, if you, it still looks bad. If you start doing a little bit more nuance and just saying, oh, the stock market went down, therefore we're going to get a recession, you can actually improve your predictability quite a bit. But even without that, even if you say stock market goes down, therefore we'll get a recession, it's significantly better than trying to pick it by randomly, because it's about 55% against about 20% for just straight going down, get a recession. But if you start looking at the length of time, how long has that market been going down, the long ones do lead to recessions, and your predictability goes up. So it's actually not too bad. It's not too bad, considering they're trying to predict the future. Okay. That wraps it up. So if you want to ask any questions, be around for a while. Otherwise, we'll start derivatives on Monday. Well, it means say, for example, if the stock market, say, went up by 10% one day, rather a lot. If you had a beta of 1.5, you would expect your stock to go up by 15%.
Yeah.
If you had a beta of 0.5, you'd expect it to go up by 5%.
What is the best point of the beta? Beta 1 or beta 0?
What's that?
What is the best point for beta?
It depends on what risk you're willing to take. It's a measure of risk. That's all it is. It's just a measure of risk. And so there are definitely fund managers who will invest in high beta stocks because in a rising market that gives them a higher return. And there's also types of funds that conservative investment funds who try to invest in low beta stock so they don't get wild fluctuations in their price.
So depending on the current economic growth, like right now, economic growth is not very good, so we need to have high return, like high risk.
Well, no, actually, what they tend to do is one of the strategies is to rotate, you talk about rotating the stocks. And so when you're in hard times, you want, because if the stock, say, the stock market went down, and you had, say, stock market went down 1%, if you had a beta 1.5 stock, your stock would go down 1.5, then at 0.5, you're going down 0.5. And so in hard times recessions, what they say is you rotate into what they call defensive stock versus low beta stock. And then when the stock market, when the economy is growing, stock market going up, you rotate into high